All right, so we've got two different styles of trade. The first thing that has to happen on this trade in order for it to set up is price gaps open from the prior day's close. So here is the prior session close right here. This is the SPY exchange traded fund, S&P 500 index. It closed the prior day at approximately $380.50. The next day, the market gapped higher. Now, in the futures market, it's more difficult to see the gaps because it's a 23-hour and 45-minute trade a day. However, in the stock market, retail traders see the absolute close at 3 o'clock from yesterday, the prior session, and then the absolute open at 8:30 a.m. today's session. So the white area that I see from here up to here is the value or the size of the gap. So we're going to take a look at the size. From the open, there's prior day's close. This was a $2.73 gap on a stock that is priced at $3.80. So $2.70 is less than 1% of the value of the stock. So this could come all the way back down and fill this gap. So if we want to trade a gap fill, we would look for a qualified sell signal. This gapped up. The open is higher than the prior day's close. This is a gap up. So in order to fill the gap, the market would have to sell off and come down to at or near this area. Then we would call that a gap fill. A gap fill. And technically, most people say the gap is filled when we've filled 90% of the gap. Okay, so what does that mean? We said that the value of the gap was $2.71. So we take $2.71, multiply it times 0.9. So if it came down $2.43, we would consider the gap to be filled. That's 90% of the size of the gap. Okay? And then at that area, we would look for a reversal trade. We would look for the market. We would want to fade the fill. So if price is coming down path, let's say we come down here and we continue to sell off. We hit the prior day's high, bounce back up, make a lower low, come down, and right in this area is where our 90% gap is filled. At this point, we would start to look for a buy signal. And then we'd look for a continuation move. There's a reason the stock gapped higher. Some type of sentiment. People are bullish about this. Could be economic news. It could be quarterly earnings. Whatever it might be, there's a reason that this thing was bought up in the overnight session and gapped higher. So number one, we're looking A, will they fill the gap and come back down? And then B, we could look to fade the fill and then potentially come back up to here and then go on to new highs. Okay, so gap fill. Let's take a look at evidence of this from yesterday's session. So in TradingView on the ES, you'll note right here, there was a prior session close. Now if you can look down at the bottom of the chart, it says 14:59. That's Central Time. That means that bar opened at 2:59 and it closed at 3 p.m. Okay. Then the market the next morning opened right here at 8:30 a.m. on the 20th, so it gapped lower. Okay, the market rallied up, and I'll leave my cursor right there. See how it almost touched the close of the prior day? So we gapped down, we rallied up, and we filled the gap. Okay, so again, filling the gap is filling the distance between the prior day's close, this day's open. I'll draw that across, and you can see that right here we rallied up and filled about 90% of the value of the gap. Now there's a reason the market gapped down this day. So we gapped down, we filled the gap, and then we fade the fill, and then we got a gap continuation. The market moved down consistent with the gap. So if we gap down, we look for a sell, and then it continues down right here. Okay, so there's a gap down that rallied up, filled 90% of the gap, and then continued in the direction of the gap. All right, now here's an example of a gap that is greater than 1%. So this market closed at 389.60. So 1% of that is $3.89. Okay, then the market gapped lower. So let's look at how far the gap was. Right here, that doji, that's the open. So see, the value of the gap is $4.48. So the gap is greater than 1% of the value of the contract. So now we're saying we're less likely to fill the gap because the size of the gap is large. Okay, we had almost a $5 gap on a $385 stock. So now what we're doing is we're anticipating the market will continue in the direction of the gap. So if we gapped down, again, there's a reason people were selling this, and the reason, technical reasons, this stock gapped lower. So now we anticipate we're going to continue to move lower. So this box represents the first 30 minutes of trading. Price pulled back up. There's our FIB sell right here. When our signal stoke goes overbought, we like to see a pattern confirmation. There's a doji, and here's a lower close. So we can sell the next bar at market right there. The initial stop right here was about $1.50. And you can see that the market moved. So from 385.80, we need a $3 target, which would be 382.80. Right there, we hit our 382.80. So that's about 16 minutes into the session. We have a $3 winner on our hands. And again, as soon as I get that lower close right there, I can buy the SPY 385 at the money put. And then in 16 minutes, because it happened quickly, we'd make probably 2 to 3 times on the put option that we would make if we just sold the actual stock. Okay, so we would cover part of the position there and then trail the stop. And you can see at one point right here our lowest low. Let me pull this down. Right there was our lowest low while we're in the trade. And you can see we hit a 2.67. We would have trailed our stops, obviously. I'll get rid of this. And then right there would have been our other exit as we get a close back above our blue line. So this would have made about $2.80 per contract. So that's, yeah.